What's up, guys? All right, let's get into it. We've got quite a bit to catch up to. I do want to go ahead, check out our daily devotional. You guys ready? Shout out to everybody who's on already. But if you're not, either way, love you. All right. The greatest investment. Jesus said to them, "Go into all the world and preach the gospel to all creation." Mark chapter 16, verse 15. Go out, go in. How remarkable. Not only do these words of Jesus open up the heart of God to all nations, but it also says something significant about our everyday life. We easily create our own comfort zone where we feel protected and safe, and we isolate ourselves from what's happening around us. Jesus, however, mobilizes his followers. Move out of your comfort zone in safe places and also from among each other. There's a whole world out there. You should not keep the gospel of God's grace to yourself. Move with it. Everywhere you find people, there's a need to be reconciled with God. Spread the blessing, always further and wider. Don't be satisfied to only receive. Be like your Father and give. So the greatest joy doesn't happen by protecting your own comfort, but by doing the will of him who saved you and called you. Invest in his kingdom by doing what God asks you. Ask of you. Amen. Amen. All right. Let's get into what this world is going on. What's going on with this world? Let's get into what's going on in this world. Now, crazy what happened with the stock market yesterday. Man, I looked at my account like, what happened? But we good. We build our investing strategy around knowing that this type of stuff happens. So it's all good, baby. It's all good. But we do need to catch up. We do need to educate ourselves. We got to learn from all this stuff because I'm a rookie, but I'm smart enough to figure this stuff out. All right, so let's look at, as of now, my positions as of now. There they go. Oh, shit. When I woke up this morning, HIMS was down like 100%. SoFi was down like 100%. And now everything's back up. It's crazy. People will panic. Tesla's ripping. Elon coming back is the best thing that could have ever happened for Tesla. He's already in his bag. It's crazy how important marketing is. With the founder, man, it's insane. It's insane. And so right now it's not looking bad. I was scared at first. I was like, damn, this is getting ugly out here. And then you look at the charts for SoFi, and you can see the RSI is nowhere near the yellow line, but it's starting to adjust. We're starting to go green. We've seen a lot of volume here, and the top of the Bollinger Band's up here, so we got some room to climb there. We're not at the very top. We're not overbought or oversold. We're kind of in the middle here at the 50 mark. So it's good. Good sign. I do believe we're in a bullish market still until I see really bad news. But nonetheless, let's get updated on what's going on with the whole 20-year U.S. Treasury bonds, because that's what scared everybody. I'm going to check out Earn Your Leisure. I haven't watched their stuff in a very long time, but because they were making everything about race for a while, bro, and hear enough of that. So not that it's not a problem, but still, man, some of it was just too extreme for me. So anyhow, let's check out what these guys think about it, and then I'll kind of give my 2 cents because I got my own opinions.
So Moody's on Friday, after the close of the bell, downgrade.
By the way, Moody's is a great company to invest in long term. Like if you're a value investor and you like good companies, whenever Moody's price drops, that might be one to cop. Moody's, FICO, what's the other one? The S&P. S&P's company is amazing. Anyways,
Graded America's credit rating from AA1 to AAA. So it lowered it a notch, and that's pretty in line with the rest of the credit agency reporting.
Yeah.
So for
We knew
people
this was
to
coming.
understand, the government has credit rating just like you would have a credit score, right? Like, so you have different credit score agencies, like you have TransUnion, you have Equifax, you have, these are people that actually give you 700, 650, 800, and then based off of your credit, that's going to determine if somebody feels confident lending you money or not, right?
Yeah.
Essentially the same thing for governments across the world, but the United States government has always had the highest level when it comes to credit rating. Now, their credit actually, this isn't the first time that it actually got lowered, but they said that the reason why they did lower it was challenges tied to the federal government's growing budget deficit, and other debts rolled over a period of high borrowing cost. I'm sure that there's some level of government instability in there and different things of that nature. So that affects the stock market. Obviously, that's not good for the market. That means that people have less confidence in the United States of America, and that's not good for a variety of different things. So, will this matter long term?
No. The thing that I do want to stress, though, is
No.
if you've been listening to Market Mondays the last 3 years, you've been hearing me screaming debt to GDP, and the bond market issue that no one really wants are bonds. I said it this weekend, the top companies that are doing incredibly well, you don't have to worry about them. I'm really getting concerned about the Russell 2000.
Why would no one want our bonds? If nobody wants our bonds, nobody wants any bonds. That's what I believe. And then it's America, bro. So people can say what they want about it. For years they've been saying shit like this, but America's still on top, right? The other thing that I would say is this stuff happens all the time. And there's patterns here that we can all learn from. And so what I mean by that is, let me see if I can pull up this data, because I created a cheat sheet on ChatGPT, but I also asked, how long this typically, when there's a bond auction and it doesn't go well, typically there's a 1 to 5% dip typically, and it doesn't last more than a couple of weeks, if not. The longest that we found in recent years was it took 3 months for the stock market to recover. But typically it's from a few days to a month and a half is normal. And you can see what causes dips a lot of times. So I'll show you guys on my screen some research that I did here on 30-day rolling calendars, right? So per 30 days, and the reason why I do this is because I sell puts per 30 days. So typically you'll see 0.5 to 1% dips 3 to 5 times a month. That's just from daily noise, mild news, sector rotation. You'll see 1 to 2% dips 1 to 2 times a month from economic reports, Fed talks, inflation. Right? We've seen stuff like that. You'll see sharp declines 2% every 1 to 3 months from war, earnings shock, bank failure, rate surprise. So I would take a screenshot of this if you wanted to and just use as your cheat sheet, because if you can understand this, you won't be so affected by news and economic reports and rate surprises, stuff like that, right? And we can also look at how long it lasts, but you can see here 3 to 5 times a month for the mild stuff, for the moderate stuff, 1 to 2 times a month, and then sharp declines every 1 to 3 months for like major shocks, right? We can look at rolling 7 days. These are weekly patterns. So every Monday, that's why they say Monday's the best time to buy. I know people say that doesn't matter. I think it does. Because in the grand scheme of things, in a year's worth of time, every penny counts. And so Mondays, it often opens weak, especially after bad news. It's a great time to dip buy or sell put, or dip buy or sell puts. So that's what I typically will do, especially on Mondays. I'll do 30-day puts or options if I'm selling cover calls or I'm selling puts, and I'm looking Mondays to start looking for deals, for entries. And then I'll sit back, unless I see a 50% increase, a 50% profit on any of those positions quick, I might close those out and re-enter. So Tuesdays, reversal from Monday's dip is common. So usually opens weak because of news over the weekend. A lot of times there's momentum going into the weekend. There's news in the weekend, and then it opens weak. And then you look Tuesdays for reversals. That's, either you want to be in by end of day Monday, or you want to be in by Tuesday morning for that reversal. And then you're going to watch for a bounce or confirmation. And the way you look for confirmation is through your charts or just price action. A lot of times you don't even need to look. I don't look at this stuff most of the time. I only look at this stuff when it's not obvious in your face, right? That's when I'll look at this stuff. But typically I can just look at fidelity charts or even this chart, you know what I mean? And I can just look for price action. Sorry. No, not this chart, but just a simple chart, whatever's in your brokerage, okay? Typically, I can just do that. Oops. No. Okay. Wednesdays, volatility spike day. A lot of times, CPI is often here. The Fed usually talks on Wednesdays, so you got to be cautious on Wednesdays. And then Thursdays are often, follow through a directionless, check economic calendars. It's a good thing, like these charts will tell you about earnings and important things that you need to look at here. But Fidelity does a good job of doing that as well. And then Friday, market often rallies and is positioning itself for the weekend. Okay, so then you also have monthly repeating patterns. The first and the third, strong inflows. You got 401k, you got fund auto deposits, right? Huge companies are funding 401ks on this time of the month. In the middle of the month, volatility, dips are common. You have CPI, PPI, Fed talks, options realignment. So usually I think it's like the 13th or something like that. So mid-month, you got to be careful because there's volatility. The third Friday, so you really want to start getting in the beginning of the month too, for those expiration dates. Which means I need to change. I need to make that change in my current strategies, because right now my options are set to expire in the middle of the month. I don't want that crap, right? Thank God it's on the 13th, but I need to get out probably the 10th or the 9th, right? The third Friday of every month, that's options expiration. So major rebalancing, fake outs. And then the last 2 days are usually choppy or positioning moves. Fund window dressing, macro setups. And then you have key triggers, right? Check this out. So CPI below expectation, or CPI below expectations, right? Usually you'll see 1.5 to 3% drops. Okay. Hawkish Fed statements. Usually you'll see a 1% drop. Geopolitical tensions, war headlines, 2% drops, especially if it's a surprise. High VIX and weak open, short-term patterns, panic selling. Tech earnings miss, Apple, Nvidia, Microsoft. It can drag the entire market down 1 to 2% because these are part of the Mag 7. So the top biggest companies make up for a huge portion of our stock market. And so even if you're not in on these companies, even if you're not investing in these companies, you probably should be paying attention to everything that has to do with these companies because they affect every company. Every company. Okay? But if they do miss earnings, that's probably a good time to find deals in other companies that have nothing to do with the performance of Apple, Nvidia, Microsoft, Tesla. What's another one? Obviously Meta. I said Meta. I said Apple. You guys get what I'm saying. And then you have a VIX clue sheet. VIX is a volatility index. Okay, so you guys can check out these numbers and stuff. And then most dips bounce within 1 to 3 days if they weren't triggered by systemic news. Selling puts after a dip with a clear catalyst often offers high premiums with less risk than chasing quiet days. Okay. And why do you want to do this? Typically, it's because if there's a dip, chances are it's not going to dip much more. It's probably going to start, you're looking for that bounce. And that's what you want when you're selling puts. When you're selling covered calls, it can bounce. You just got to be careful that it doesn't bounce too high and go above your strike price. So you almost want to sell covered calls on green days when something seems overbought, right? Because it can't go up too much, but if it drops forever, however long, you'll collect premiums unless you want to get rid of the stocks that you're holding. All right. So let's finish watching this video. I hope that helped, by the way.
Or any mid-tier companies that are not performing incredibly well. And truth be told, if we continue on this path, our credit rating should be lower than what we were given by Moody's. On the investment side, Moody's is actually a great company to invest in.
Didn't I say that?
Ticker MCO. It's one of those hidden gems like FICO that people don't talk about enough. But Moody's is a good company to.
I promise I have not watched this video. So shout out to Earn Your Leisure. I promise you I haven't watched this video.
Invest in long term, but I think we have something like, I don't know, $4 trillion that we need to refinance. It's a lot of capital, and I don't know what the terms of the refinancing is going to be, given what the rates are. So I'm not surprised at this downgrade. Like Rashad said, this is not the first time it's been downgraded, but in the long history of the stock market, it's actually been a great time to buy the best companies in the world. So I wouldn't worry about it at all.
There's some rhetoric going around from political officials about the importance or significance of Moody's going forward. You got any thoughts on that? Like, should we even be using Moody's as a scale to measure the barometer of where the economy is?
Would it be at InvestFest? Or because that would Moody's, if you are, they have had a tumultuous past, I'll say, in how they've rated things in 2007, 2008. I will say that. So, but all the agencies are saying the same thing. Our credit isn't where, like, we're not loved how we used to be. I don't know how much more we need to be labeled this point. So, and with that debt being so high, I don't see a plan in sight on how to correct it. There's a lot of entitlement.
I think that's propaganda. I think there's a plan. I think America's going to be just fine. I think we just keep growing our GDP, which there's a lot to be excited about with AI, with NVIDIA, with OpenAI talking about going public, buying a phone design company. There's a lot to be excited about. And so it's no different than if you have $100 million worth of assets and and you can grow it to $150 million worth of assets, but your debt goes up by $5 million, $10 million, you're still going to do it because the economy grew. Your net worth grew substantially. And so just because our debt increases is increasing, as long as we are managing our growth and our expenses, debt can grow a little bit, especially since we're not on the gold standard, and we are the biggest consumers in the world, 25% of the world's GDP. And that's not going anywhere anytime soon. Doesn't matter if we have manufacturing jobs or not, because our money's not made through manufacturing. So anyways, guys, I don't know if you remember, but I created a easy to follow, I think it's easy to follow, stock investing course. If you go check out any of my videos on investing, you'll see a link to this course. And so what I added at the very bottom is the market dips cheat sheet, and everything we just talked about is here for you to check out. So, dip frequency per 30 days, weekly patterns, monthly timing patterns, common dip triggers, all of that is in here. So hopefully you guys get rid of all this. We'll rock with this. Yeah, that looks pretty good. All right, so it's there now. It lives there. And so you can just click on that link and you'll see it. Let's keep watching this video, though.
Entitlements that are owed. Debt to GDP continues to climb. I mean, in 4 years, we should be at 130. That's too high. But yeah, Moody has had some issues before.
Wait, what? Debt to GDP, we should be at what?
GDP continues to climb. I mean, in 4 years, we should be at 130. That's too high.
Why is that too high? I don't know, man. So are you shorting the market?
But yeah, Moody has
up,
had some issues before in terms of how they rated things. But I think there may be some leadership issues at a few of these agencies that will determine where we rank. I think we should technically be lower.
Yeah, we went one notch down from AAA, which was the highest rating. So we went one. There's 21 notches, and we just came down one.
Yeah.
Like you said, overlasting debt.
Moody's, but that's a great stock if the price is right. But it's also more so for those value investors and stuff. If you're trying to grow, I highly recommend follow this stock investing course. I highly recommend y'all follow this. If you're trying to grow your portfolio, I highly recommend you try this. Value investing is cool, but imagine you can see cash flow coming into your account every single month while growing, while your portfolio grows. It's hard to follow individual stocks and stuff. And I can do it. I have the time to do it, but most people don't have the time to do it. What I suggest is finding great stocks that you can trade options on. Buy and hold the indexes, dollar cost average the indexes. And while you're selling puts on great companies, if you get assigned those companies, that's when you buy those stocks at a great price. And then you just start selling covered calls on them. And if you want to keep them, you make sure that the strike price is at a price where it's going to be very, very hard to hit. So you're not collecting as much passive income every single month, but it's because you like the stock so much you don't want to sell it unless the premium is worth it, unless it skyrockets, which is risky. But if you don't want to keep them, then you keep the strike price at a place where the probability of hitting that strike price is higher. You collect more premium, and you might not hit that strike price for 90 days. Who knows? But through those 90 days, you've collected premium cash flow every single month. You're still getting exposure to growth in the market. Or you can make your own index fund and buy the individual stocks. Freak it. But I wouldn't do that until I had a lot of money. Like, I think if I had $100,000, like if I could buy 100 shares of each of these stocks and sell covered calls, then I would start buying stocks. But unless I'm willing to buy 100 shares of any given stock, so let's say, name a company. Let's say it's Moody's. Let's go check out Moody's. Let's go check out Moody's real quick. MCO, stock ticker MCO. All right, so you guys can see my screen here. All right, so like look at this company. It looks amazing on paper. Do you see that? Revenue growth every single year. Okay. Profitable, free cash flow out $2.5 billion last year in free cash flow. Insane. Net income, dividends keep growing. It's got some debt, but it can pay that debt off in a year. In 2 years, it can pay off that debt. It's buying back stocks. This is everything you see in a great company. Valuation, price to earnings has dropped quite a bit. Not great. And then let's look at employees. It's growing in employees. It cut a lot of jobs. Is this real? What the hell? Okay, so anyways, and then we can look at the valuation. Like, is it worth it? The PE ratio is of 40, 30. It seems like it's overpriced, but we can run it through ChatGPT and see what it finds. So all right, so let's see what it comes up with. In the meantime, we can continue
At
watching.
high interest rates. Where's Doge at, man? We need them.
No, they did Project 2025 right there.
It's crazy.
See what I'm saying? Like, why are you so anti-Doge? What seriously, what policies, what executive orders has Trump signed that the people didn't vote for? Everything that I've seen Trump do, the people voted for. And look, I don't agree with everything, but our government, our country works a certain way. Like, it's all good. Had Obama and Biden for 9 years or for 12 years between the two of them. Do y'all like the direction that the country went? And I voted for Obama twice. I didn't like the way my kids' schools was going. I didn't like the way the division that was happening. Trump created more division too, don't get me wrong, but like all of it is whack. And people decided they voted for a world with Trump rather than the Obamas and Bidens. So not to get all political, but this is part of why I stopped watching EYL, because everything's so politicized, bro. Like I can be center left, center right, and not shove my ideologies in your face every single time we talk about stocks. And I see it from both perspectives. Why do people hate Doge so much? Anyways, let's continue. Oh, but real quick, so yeah, everybody's saying it's overvalued. Yeah, the PE ratio is 40. This isn't a tech company. That's high for a company that's not a tech company. But they have great financials. They have great financials. The question is, can it keep up with this? And so for me, I like Moody's, but I'm going to check back when the stock price, like if I see news headlines, Moody's drops by 30%, then 50%, like what happened to the United Health, I would buy Moody's. Like United Health was a buy all day. It's just outside of my investing strategy. And I don't like the company's morals. And so I felt good about not buying it. I ain't got to make money from every deal. But that was a no-brainer. United Healthcare. The way it drops that much, it takes a lot for a huge company of that size to never recover. Like a lot. So yeah, Moody's looks overpriced, but it's a great company. Similar to FICO when we looked at FICO. Standard & Poor's or S&P, that's another great company to check out as well. Let's keep watching.
Yeah.
And that is a fact. Okay.
And the VIX barely
That's a
moved off
fact.
the news. It wasn't like the VIX shot up to 35 as a result. So it's one of them slow news day kind of moves. Go ahead, Rashad.
Speaking of crypto, if you are interested in Bitcoin, cryptocurrency as a whole, learning about the difference between hot wallet, cold wallet, really, you know, learning how to secure all of this stuff and detailed breakdown as far as, because it is kind of complicated. What you should do is actually get your tickets to InvestFest, because we will be going over crypto.
When is that?
In depth. We got a few surprises.
I will go to that.
The crypto community. But
what's up? Y'all trying to go?
Cryptocurrency will be.
Y'all trying to go to InvestFest? Let's see when is InvestFest. Y'all think it's worth it? Give me an excuse to go visit my brother. He lives in Atlanta. Might hit up Vic, see if he wants to go. Holy smokes. Holy smokerooskies. Look at this. Lifetime VIP, $10,000. Platinum VIP, $5,000. And here's why. The $5,000 ticket is going to get you Friday, Saturday, and Sunday access, vendor marketplace access, VIP private event access, music performance, swag bag, VIP seating, VIP private, VIP autograph memorabilia, meet and greet with Earn Your Leisure, access to previous recordings of InvestFest. I think I'm gonna skip VIP. Not saying it's not worth it. I'm just gonna skip it because I've never been. I want to see what this is about first. So I probably will do. Damn, general admissions $250. They killing it with InvestFest as a business. Damn. VIP admission. What does that give you? Nah, we're gonna do this one right here. We're going to do this one right here, brother. That's in August. So as long as I remember, we'll go.
We'll be part of InvestFest for sure. InvestFest, the world's largest business festival held in Atlanta.
They go every year? Okay. Yeah, so August 22nd, $250 for all 3 days. That's not bad, actually. I mean, I don't even know. What is the Orlando premiere tickets these days? That's not bad for 3 days. You heard it fell off because of Diddy. What? Uh-oh. Uh-oh. Like people stopped going, stopped supporting. Was he like heavy in this event? Yes. That's cool. Might have to go. Might have to go. I like the website too. The website's fire. Check it out. The website's fire. Topics, discussions, investing, taxes. Okay. All right. So that covers what happened with the bond markets and all that with the bond auction. Now, quick update on Tory Lanez for some current events, for some culture talk. Free Tory Lanez. Let's see what's going on here.
Very much, Chris. Thank you for having me. It's an honor to be here.
Well, listen, this is the job.
Tory's dad got swag, don't he?
Is to make sure that there is fairness under law in this situation. And with your son,
Yes.
There's now a question mark. And you're not a lawyer. It's not why I'm talking to you. My understanding is It's gotten bad enough for him on the inside after this stabbing that it is a miracle that he survived, that now he's being moved as we speak. Is that true, sir? And what does that mean to you?
Yes, that is correct. It's one of the things we've been concerned about, but he's being moved because it's a part of the prison's protocol. That when a situation like this happens, I think they believe it's better for him to be in another facility, and so he is being moved as we speak. One of the things, of course, we're concerned about is because my son is a high-profile person, and when things like this happen, there's always some kind of weird news going out trying to spin it to be something else. You know, maybe he went crazy in the prison and they moved him. You know, there's a lot of stuff that happens, but the truth being that he is being moved right now as we speak, and we have concerns because, number one, he has just been discharged not many days ago from the hospital, and he was discharged with 14 stab wounds. You know, an incident that collapsed his lungs that, you know, again, thankfully, he is recovering, he's doing well, but now he has to take a 3-hour ride. And he is the victim in this situation. Those are the things that really concern me. He is the victim. He never provoked this incident in prison. And anybody that knows him, in fact, I've met many people going there to visit him, my wife and I, that will tell you that he is someone who is liked. He's not someone who's a troublemaker. I was with the COs, the correctional officers, in the hospital where he was taken after this incident, and the COs spoke to me. They said when they heard on the intercom that they had to transport somebody to the hospital, it was him. The guy looked at me and said, why him, of all people? Because he doesn't do anything like that, you know, to warrant these kinds of things.
Well, listen, Mr. Peterson, we'll
Chris Cuomo, I was going in a little bit on him in the beginning of his video yesterday that I checked out, but he brought up the Live Nation thing. Like this case is crazy, bro.
We're going to stay on it. Not out of any deference to your son. I'm new to this story, but there's something about it that doesn't smell right. And we're going to stay on it until we figure out what this is really about and that justice is served here. And I hope he is safe, no matter which way it comes out. And we're a call away if we can help you with any concerns you have, okay?
Absolutely. I appreciate that.
All right. God bless. Stay well, and we'll be in touch.
What's the comment saying? I feel like most people believe Tory's free. Yeah, everybody's saying Tory's free. Yeah. What do y'all think? Y'all been watching the case? I feel like the deeper I dive in, the more I believe Tory's innocent. It's crazy. Crazy times. Now, you guys know I like Jamie Dimon. He is the CEO of my favorite bank, Chase Bank. Best credit cards in the world. Let's see what he has to say about the markets not pricing in the geopolitical risks that we're seeing that are unfolding. Usually the markets are good at pricing that type of stuff in. And so this might be something that we need to be aware of, we need to pay attention to, because it's been a very volatile market. Let's check it out.
Extraordinary complacency that markets are not pricing in the risks. With what we saw in yields overnight, is that a reflection?
I wonder how you know whether or not a market is something is priced into the market.
Of risks being priced in?
Yeah. So I talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's, you know, QE, it's fiscal deficits, it's global fiscal deficits, it's, you know, potential of the trade wars, it's these huge, complex geopolitical situation.
But everyone's paying attention to all that stuff. You know, so I asked ChatGPT. And it says, the market reaction is shrugging off big news. If serious geopolitical events occur, invasions, major attacks, military mobilization, and stocks don't fall much, the VIX stays low, safe havens, gold, bonds, USD barely move, that's often a sign that the markets believe the issue is local, not global. It'll be contained quickly. It won't affect major economies or trade flows. But the threats escalates, you'll see a delayed reaction, meaning it wasn't priced in. I see. So an example, the initial Russia-Ukraine buildup in 21-22 didn't move markets much until the invasion began, and then the panic kicked in. I see. So does Jamie Dimon believe that things are worse than they truly are? Because we know that not everything is great, but we also don't have the uncertainty that we had before. We see that there's conversations being had, a lot of positive news. And so Jamie Dimon might know things that we don't, but at the same time, isn't it in his best interest to move the markets whatever direction he wants it to be? I don't know, because he's with JP Morgan, right? He probably wants. Does he want rates to drop? I don't know. This is difficult. So another reason why is checking implied volatility. So IV, index options, stocks exposed to affected regions, oil, defense, airline, or semiconductor sectors. If the IV is still low in these things, then it's probably not priced in. If IV is unusually low despite rising tensions, this means option buyers aren't expecting major moves, so fear isn't priced in. Selling options may become dangerous here. News cycle is focused on other stories. So markets are reactive. If geopolitical risks are real but headlines are dominated by earnings, inflation, or politics, then fund managers might not be repositioned. There is a lot of politics going on, but I feel like it's mostly geopolitical stuff. Retail investors aren't watching it. No narrative shift has happened yet. Supply chain or energy routes are threatened but ignored. That's a big one. That's a big one, the supply chain issues. And I think people don't realize we're about to get rocked by that. I think we are. I could be wrong, though. Asset correlations aren't breaking. Yeah. All right, so in summary, low VIX. Fear not priced in, because right now you look at the fear and greed index, and let's look at it. And yeah, it's a 68. It's a 68, but it's dropping now here in the 125-day moving average, the S&P 500. But everything else is screaming greed. Let's look at the VIX. Yeah, and the VIX is low. What does the VIX tell us? It's the volatility index. Tells us about the market's expected volatility over the next 30 days. It's calculated using S&P 500 index options and provides a leading indicator of market sentiment, often referred to as the fear gauge. A high VIX suggests investors expect price fluctuations potentially due to increased uncertainty or fear. And the VIX is low. I think Jamie Dimon has a hell of a point, actually, because we're not out of the storm yet. You know, supply chain issues are about to start kicking in June, July. That's where we're going to see, like, we've been watching, following the world, you know, for the last 30 days. I've been live streaming almost every day. We're seeing unemployment, people, you know, firing the hell out of people. We're seeing prices go up across the board, across many different industries. Man, this is a tough time to be in the markets, but nonetheless, we've been printing lately, so let's keep watching this.
Here at QEF, we've talked about growth areas.
You've always talked about how there's been, when you take a look at yields, they are at higher levels than they were
I don't want the reader to say he's predicting, I'm not, but we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And
what do you mean, do I talk about equity on here?
Infrastructure needs are inflationary. Now you have offsets. You have
what equity?
Oil prices down quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised. And I love to read economic history. So you can look at models. I think it's also very important to look what happened in 72 and 74 and 80 and 82 and 1990. Surprises happen, and most economists and most models don't pick those inflection points. And those inflection points are often driven by geopolitical complexity, things you don't necessarily know. And we had the oil crisis in 74. So we just want to be prepared for everything, so we can continue to serve our clients through thick or thin.
You talk about how concerned you are about debt, and of course, add to that the tax bill that's being voted tonight, they say. That's going to make it a lot worse. Your take on that? Yeah, well, the United States is running the largest trade deficit that we've ever had in peacetime, almost 7% of GDP. And however the tax bill gets done, they'll probably add a little bit to that. I still think it's better that we get certainty around tax bill. I'd rather get that done, but I do think at one point Americans that would attack its deficit problem. So do a lot of Republicans think that, so do a lot of Democrats think that. And that attack isn't just raising taxes, it's having proper policies around incentives and growing business. And I just got back from Europe last week, and everyone there is talking about growing the economies, getting more investment, reducing the regulatory environment that slows down growth, keeping everything safe for food, water, banks, etc. But I think governments have to do a better job at that. And so pro-growth, pro-business is a very good thing, and hopefully that can offset some of the extra spending one day.
I don't know what happened, man. YouTube ain't rocking with me. YouTube made a documentary about me, and then they just stopped rocking with me. The algorithm just stopped pushing me.
As we said,
it's all good. We gonna build this back up, and people gonna find me because they value the content. If not, it's all good. I'll just keep sharing. I keep doing this because it's been benefiting me in real life anyways.
It is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like? Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here. Let's turn our attention to China, where we are. Is it still a priority market? Because even as your rivals de-risked from China, pulled back, you actually boosted your resources here. How are you looking at China in the next 12, 24 months? Yeah, so we invest for the long run. So I don't look at, we're not buying and selling the stock when you say invest the next 12 or 4 months. And look at this conference, we have, when I first came, it's 21 years. The first one we had a couple hundred people here. Now we've got almost 3,000 people here. I think 1,300 companies, investors from 33 countries. We do research now, I think, on 400 Chinese companies. We're a long-term investor here. Yes, there's all these other issues cause consternation, but we have to deal with the world that we have, not the world we want, and we'll continue to grow. We cover, I think the number is 1,700 multinationals around the world in China. And these are, clients of ours from Latin America, from Europe, et cetera. And we take a lot of Chinese companies around the world. We have Mandarin-speaking folks in Brazil who speak Portuguese and Mandarin so that we can facilitate commerce between Brazil and China. So long-term investors concerned about, the current environment. But I think hopefully it will all sort out, but we're not going to pull back. I mean, I gathered the story that came out there. Somehow we're cutting back in China. That's completely false. But we understand we're going to have some political pressure until all these things resolve. So you're looking at China as one of the priority markets to invest in the next 12 months, perhaps. Is there consensus within the leadership that this is the place to be? You talk about taking a longer-term view.
Yeah, the consensus is that companies are going to be doing business here. There are going to be some adjustments because of the trade negotiations, but I don't think the American government wants to leave China. And we just had our Secretary of Treasury meet with the authorities here, and they're talking about having a.
I'm glad he said that. A lot of people got this idea that that Trump is a nationalist and he doesn't want any globalization. And what I've seen from his actions, what I hear from his voice is nationalism. But I think that's a art of the deal type of thing, right? What I see is globalization. I see him wanting NVIDIA to work with Saudi Arabia. I see him trying to create peace between us, the Middle East, inside the Middle East, between all of these groups that are also terrorist groups. He's even talking about, growing their economy so that they stop, trying to do crazy shit, to be honest. And he talks about making recognizing Palestine as a state, but also making an agreement with these Arab countries in the Middle East to recognize Israel as a state. So I think these are all really, really good things. But I also wanted to point out, that the same thing with China. He was playing hardball with China, but he doesn't want to stop working with China 100%. We just need to be a little bit more self-reliant. And we have to be careful because at the end of the day, China has different views, both culturally and politically. And if they could have it their way, they would run the world. Trump doesn't want to lose. We shouldn't lose, especially under his watch, especially under any president's watch. We shouldn't want to lose the global power that we have. Now, with that being said, a rising tide raises all ships, man. And it's going to be very difficult for China to go to go from manufacturing as their primary source of income in their GDP in their economy to what we do. We already do what we do. We do tech, innovation, services. The partnership can grow together, right? And across the world, it can as well. So I'm glad Jamie Dimon said
in a good relationship. I'm glad that they engaged, talked about what we can do and improve things. I hope they have a second round and a third round or a fourth round, and I'm hopeful they'll end up in a good place. And
in terms of China's
but if you look at China, they go way back. They've done an enormous job over the last 20 years lifting up their people. That doesn't mean I personally agree with everything they did. I'm a full-throated, red-blooded American patriot, capitalist, but I understand that they're doing what they can to lift up their country. And here, I've seen their cars and their AI and they've done a pretty good job, and we should look at America and say, okay, we're going to have to compete too. And so I'll leave foreign policy to the experts in the government. So.
Companies get caught up in the crosshairs of the U.S.-China trade tensions. I think J.P. Morgan got caught up in the CATL listing in Hong Kong. You maintained your position. Yeah. Why?
Because, first of all, a foreign policy set by the government. It's not set by J.P. Morgan. And the government did not sanction CATL. There are people who didn't want us to do it for a bunch of reasons, and they may have somewhat legitimate reasons, but I think the government should decide what to do, so we aren't going to do that. If they had told us we couldn't, I would salute and move on. I would have no choice. And so there are legitimate issues around national security. So if you went through all those issues, I understand that. We don't think it really applied to this particular thing. We and other investment banks did a lot of due diligence around all the issues that people raised, and I'm sure I'll be criticized about that too. But if we thought it was wrong, we wouldn't do it. So.
Do you expect more pressure?
But we're getting pressure from governments everywhere about just about everything.
So I love this. I love Jamie Dimon. We all can learn a bunch about that, and I agree. The U.S. needs to have a strong, prominent presence in the East and in Europe. It helps us develop our AI. The competition is good. It helps us expand our economy, but the world's economy as well. and it's just good for our quality of life. So, yeah, I can agree with that. One asks, "Hey, boss, a quick question: which core position should I pick for Fidelity brokerage account? Money market fund or interest bearing cash? Whichever one's paying you the best. You know, I don't know what the rates are. Let me see. Let me see if I can see how much what I chose. If I can even see that. I was gonna look on my app, but I feel like that's not gonna be easy to see. Go to portfolio. My goodness. I gotta get back in the gym, man. I've been slacking on the gym. I don't know about y'all, but we gotta get back in it, man. I've been slacking, man. Summary. Okay, this is it, I think. No, yeah. I'm not sure where I can even. I know there's a way to see it. I just don't know where. Y'all want to see something cool? This is how much I've invested into this account. And this is my balance right now. Yesterday it was at 42,000 or more. So in year to date, I've doubled this account. I'm trying to get it to 100,000 by the end of the year. And this is just the strategy that I've shared with you guys in that course. I'm just running that strategy. Selling puts, if I get a sign, covered calls, and I just keep dollar cost averaging into VOO and QQQ. That's all I'm doing. And so far this month to date, I'll show you guys where I'm at month to date. And these are closed realized gains. These are realized gains. So month to date, I'm up 62.80 just from options. And these are each of my transactions. So I was trying to hit 10,000 by the end of the month. And so where I'm at right now in my open positions, I'm down 36% on HIMS, but I could make $1,800 on this play. Okay, so HIMS was a $50 strike price. It came crashing down today. Bro, it was at $65 yesterday. Let's look at HIMS real quick on this chart. Let's look at HIMS. HIMS, look, earlier this week, what was that? What date is this? This is May 14th. It was at $66 almost, $65.91. Bro. And I got in right here. What a dummy. If I would have, and you know why I got in, guys? Because I didn't look at the charts. I was crushing it already. I had entered in here, and within a few days, I had like 70% profits. So I closed it out. And I got in again. But if I would have seen, it was already at the top at the Bollinger band, and the RSI, it was above the yellow line, way above the yellow line. Not only above the yellow line, but it was above the 70. Then I would have known it was way overbought. But I didn't pay attention to the charts. And so now I'm praying it stays above $50. So my strike price is 50. Right now the stock price is at $50. But look, it's well below overbought. It's below the Bollinger band. But it's also above all of the SMAs. So I'm hoping it starts to turn around. It expires on the 13th, so I got 3 weeks left. If not, they're gonna assign me these contracts, and I'm gonna try to sell covered calls on it at some point. That's the goal. This might be my first failed trade out of, if you look at my portfolio and you look at my closed positions, I've not lost a trade all month. This doesn't count because that was in the same day I got in and out. I bought this on accident. So this one don't count. But the rest of these, not that I bought this on accident. This was a 2-year call that I copied somebody else's trade, and it's out of my strategy, so I got out of it, and I pretty much broke even. But if I lose this HIMS trade, that'll be my first L. So I'm at 62.80, right? And if you look at the possibilities by the end of this month, there's 1,800, 2,400, 2,600, 30, let's say 3,400. Yeah, so almost, not quite $4,000. So 3,800. So if I end up being 100% profitable on each of those, which I probably won't, then I could hit 10K. But it'd have to be a perfect month to hit 10K in gains for the month. I don't think that's going to happen, but we'll see. We shall see. Okay, let's check out no tax on tips. Let's check that out. And then I'm gonna give you guys some tips on how to make sure that you're in compliance. For those of you guys that are new to my channel, I own an accounting firm, and that accounting firm has cracked 340 customers and 24 employees. It keeps growing, man. And what I realized is that would make my accounting firm one of the bigger accounting firms in the country. Nowhere near the biggest. It's probably in the top 10%, but it's not in the 1%. And the difference between top 10% and 1% is drastically humongous different, right? All right, let's check out this Ted Cruz video where he's taking a victory lap over the no tax on tips. This should have been a thing.
Madam President.
The senator from Texas.
You know, I remember as a kid in Sunday school thinking what it would have been like to live in Israel in the age of the apostles, in the time of miracles. And yet, perhaps we have been transformed to another time of miracles. Yesterday, I was at the White House where President Trump signed into law bipartisan legislation, my legislation, the Take It Down Act, that I authored with Senator Amy Klobuchar to protect women, to protect teenage girls, to protect young people online from non-consensual intimate images. We saw both parties come together and pass landmark legislation. And just a moment ago, 24 hours later, we saw the same thing happen. And so I thank my colleague from Nevada for moving for this to pass by unanimous consent.
Unanimous.
And I want everyone to reflect on what you just saw happen, because it is...
Great point. It's been a long time since everybody in politics, all of our politicians agree on something.
It is consequential. Last year, in the midst of the presidential campaign, President Trump at a rally in Las Vegas announced his policy proposal of no tax on tips. And Madam President, you will recall that the week after he announced that, he came and had lunch with the Republican senators, and he told us the backstory of where the idea came from. And he said he was sitting at a hotel in Las Vegas getting ready to go to his rally, and he said he was having lunch there, and he said a waitress came by, and he said she was beautiful, which I believe him. And he said she was complaining about the burden and the paperwork of paying taxes on tips and how challenging it was. And he said he pulled out a pad of paper and he just wrote on the pad of paper, no tax on tips. He said, what do you think of this? She said, great. And he went to the rally and he announced it, and as he told us, the entire crowd went nuts. Now, I got to say, when he announced that policy, I thought that was policy genius. The next week, I drafted legislation to implement no taxes on tips. And I introduced it in the Senate the very next week. And within days, both senators from Nevada joined my bill as co-sponsors. As the senator from Nevada just described, she told me on the floor, she said, 25% of all workers in the state of Nevada are tipped workers. And this is common sense, bipartisan tax reform. Look, I think we ought to be fighting for waiters and waitresses. We ought to be fighting for bartenders, taxi cab drivers, Uber drivers. We ought to be fighting for beauticians and nail salon workers.
Come on,
we ought to be
say
fighting
barbers.
for all the men and women who are working and working hard. We ought to be.
Barbers never get mentioned. I'm just messing. Notice he didn't say Starbucks cashier. I'm just messing. Don't come at me. But I'm kind of not. Like you, I gotta tip you because you grabbed my muffin for me. You know, like I'll go to like one of these festivals where they have, you know, the tents and stuff, and I'll buy like dog treats for my dog, and they want to tip. Like I thought that was a service thing. You know what I mean? And I get it. You got my money, you grabbed my money, you got me the muffin, but I don't know. I just feel like it's tip culture in America has gotten insane. And I'm a barber, and I tip well, but sometimes it's like, damn, here too? There was one that really took me out, bro. I forget what it was, but that shit, when the tip thing popped up, I remember being shook. Like, damn, here too?
We got to be fighting for casino workers. Sorry to leave them out. As a longtime poker player, I certainly don't want to leave them out.
Yeah.
But we ought to be fighting for blue-collar workers across this country. And I will say I've urged the House of Representatives, I've urged the White House that we should take up no taxes on tips in the House and pass it. And I said, look, if the House passes it, I think there's a very real chance the Senate will pass it. It's bipartisan legislation. And what we just saw is the Senate passing no tax on tips 100 to nothing. Every Democrat voted yes, every Republican voted yes. And by the way, the backstory, just kind of pulling the curtain back on how this process operates. The way the process operates is when you're seeking to pass something by unanimous consent, you circulate what's called a hotline, and every senator gets the chance to say, are you going to object? And on the Republican side, every senator said, nope, goodbye me. And on the Democrat side, every senator said, nope, goodbye me. And so this is now passed, and we are sending it to the House of Representatives. Here's the good news. With what we just saw now, the certainty
I got you, Nate, if you still on.
No tax on tips become the law of the land, I think is very close to 100%. As the senator from Nevada mentioned.
Yeah, so I guess he drew up the legislation, wrote up the legislation for it, for the bill for it, and it has gotten passed. And so I think this is what you guys need to know. So you have to track all your tips, cash and digital. There's been a time where especially barbers, because I'm in the barbering industry, it's just all mashed together. Well, now it better not be, because $25,000. For me, I'm at the top tax bracket. So if you're a barber that, let's just say you're a barber that makes $100,000 a year. And of that 100,000, okay, of that 100,000, let's say 25,000. And this sometimes it's more than this. This is very likely a very likely situation. Of that 25,000, of that 100,000, 25,000 is tips. Okay. Well, let's just say, because we have a progressive tax bracket, right? You know, for the first 10K, you might pay 0% in taxes. For the next 20, from 10 to 25. Actually, let me give you guys a real case scenario. What did I do here? Oh shit. Hold on, guys. Let me log in here. Okay. Show me the federal tax bracket. USA. So check this out. So I'm going to zoom in so you guys can see the actual numbers. So from 10%, so from 0 to 11,925, you pay 10% in taxes. Okay. Now, there's automatic deductions that you get up to a certain point and all that good stuff, right? People think that if you make, let's say you make $30,000, that you're going to pay 12% on all 30,000. No. For the first 11,900, you only pay 10%. From 11,925 to 30,000, you would then pay 12%. But if you had $100,000, right, that would mean from 48 to 100, you're paying 22%. From 11 to 48, you're paying 12, and then from 0 to 11,900, you're paying 10%. And so what I would do is I would ask, what would be the effective tax rate for an income of 100,000? And it might really break this down. Let's see. Assumed after deductions, and it did. So the $15,000 standard deduction for single filers. So it breaks it down. Look how amazing this is, bro. 10%. So you're going to pay $1,100 on your first $12,000. That's going to be your tax bill, guys. So it's going to break it all down. Your effective tax rate is 17%. It's not 22% because you make 100 grand. It's 17% because of each of these brackets. Okay. So, by the way, if you are self-employed, check this out. So that's your federal tax rate is 16.91%. Okay. And then you have state tax. And then you have property taxes. And then you have what's called employee or self-employed taxes, right? So check this out. Let's say you don't own a home. People say, I don't pay property taxes. I don't own a home. Trust me, your landlord is passing that on to renters as well. Okay. So your rent is going to also reflect whatever property taxes are. So in higher states, a lot of times, in high property tax states like Florida or Texas, you're gonna be paying for those high property taxes. If property taxes were lower, your rents would drop. Unless landlords don't care. But then they would, it's a competitive market, so whatever. So let's say your state is another 5%, right? And let's say your employee tax is another, 7.65? 7.65%. That's your FICA. That's what you're paying for Social Security, all that stuff. Well, if you're self-employed, you're not paying this, but you're paying double. You're paying 13.5% around that. Okay. So add 13 plus 5 plus 17. If you own a property, Add that. What about sales tax? Guys, we get taxed like crazy in a country that for the majority of its existence didn't have federal taxes. Federal taxes are kind of a new thing, and they were only supposed to be when we were in war times because we had to raise capital to fund the war, to fund our defense as a country. But our politicians figured out a way to keep it this way, get rid of tariffs, and we get stuck with crazy bills, okay? And the more money you make, we know that 50% of Americans don't pay any taxes. 50% of Americans usually get a refund. It's another 50% that pays taxes, and it's usually the small business owners, small business owners, which a lot of times are middle class, and the wealthy. Those are the ones that are paying for everything. Okay. Now, with that being said, we need to track all of these things. And what a lot of people don't realize is that if $25,000 of your income is being taxed 16.91%, how much money are you saving there? Let me do the math here because 25,000 times 0.1691, you would be saving $4,227 in your tax bill. So it is 100% worth it to keep track of your stuff. This is why we tell people all the time, if you're not going to do it, hire an accountant because it should pay for itself. What you don't want to do, though, is make your accountant's job a headache. And what I mean by that is there's so many people, service workers, barbers, hairstylists, bartenders, that take tips on Cash App. Well, unless you're going to categorize every single transaction and make your bookkeeper go through that, and it's going to be impossible because a lot of times this is what we'll do. The haircut's $20. How much you want to pay? Oh, just run it for $30. Guess what you're going to pay taxes on? You're going to pay that 16.91% on the entirety of this if you run that on your Cash App. You can run 2 transactions, one for $20 and one for the $10 tip, but that's a freaking headache. You're never going to keep up with that. This is for people who use Cash App, right? Apparently, Venmo has a business account where you can separate the two, just like Square. What I tell people is go get a Square account because whatever you charge someone, it'll charge them and then the tip screen will pop up. And on your reports, it'll automatically categorize what was the revenue and what was your tips. And then that way you make your accountant's life easier and it's easy to track. And if you run it up for $25K in tips, you just saved more than $4,000. Cash App doesn't allow you to separate it yet. I think Venmo does with a business account. And just keep up with these apps because I'm sure these apps want to stay in compliance and they don't want to lose customers over not being able to save on tips. So I'm sure they're going to release those features. You just got to make sure you're paying attention to that so that you can save all that money. I hope you guys, I hope that was helpful. The IRS wants to tax me something. Man, they want to tax everything. They want to tax everything. And it's crazy. And Juan, I appreciate that, man. That's love. All right, so I think Concise left, but he wants to know about like equity, like the benefits of owning with the opportunity to use equity from it, brick and mortar. It's the same thing as, look, when you're investing, leverage, using debt, is a thing for anyone trying to build wealth. Elon Musk used debt to buy Twitter, and he's the richest man in the world. Jamie Dimon, trust me, uses a lot of debt. I mean, he's in the banking world, right? That's very important if you want to build wealth, but you have to be smart about it. You got to understand finance in some way, shape, or form. You can use debt against any asset, really. Almost any asset, you can use debt. I've used debt against my inventory in my warehouse, against my personal home. I've used debt. I've taken a loan. I've taken a line of credit on my home, and on the same home, used it as collateral for an SBA loan, right? I've used debt against my stock portfolio. You can use debt against your small businesses. You can use debt against invoices. If you get with the right banks and the right banker, there's a lot of things you can use debt against. And that's why it's important to focus on assets. So take your cash flow, park it in assets, leverage the assets, build more assets. Those assets will create more cash flow. It's like a wheel. It's like a flywheel, right? It's literally a snowball. It's literally a snowball. And so to give you an idea, like with real estate, you might buy a house in a upcoming area. Like if you understand real estate, then you're looking for job growth. You're looking for great schools. You're looking for areas that are starting to get gentrified, and you're getting in there and you're buying something that needs some value add. Sometimes you can get, depending on the market that we're in, sure, you can buy something that's turnkey and make money that way as well. But a lot of people, all they do, the play that they run is they buy a home. And I like house hacking. I don't like investing. It's a full-time job to invest. But if you're going to live somewhere anyways, I like house hacking. And so I'll move into a house for 2 years. Okay. Fix it up while I'm living in the house. Make it nice. Make it nicer. Make it look better than it did when you moved in. Okay. In an area that's thriving. In a thriving area where there's job growth. So you want to see, and thank God for ChatGPT, because I used to have to like scour the internet for this data. But now with ChatGPT or Grok has been fire, by the way. Let's see. What is the economic growth forecast? And let's go with Zephyr Hills, really small town. All right. So what I typed here was, what is the economic growth forecast in Zephyr Hills? I'm looking for demographic study and future growth for potential real estate investing. And so we're going to look at this. Zephyr Hills is a small town. Look, population is, in 2023, the population was 18,000 people. It had a 5% increase. Employment grew by 9.2%. And then these are the key sectors. This is very important because key sectors have direct impact, but they also have indirect growth impact. And you can see that. You can look up what industries have the most job growth impact. And it'll say something like construction, because construction, creates jobs and GDP and economic growth in that area across many different sectors. So key sectors include office and administrative support, sales, food preparation, and service. Shows you the median household income. Usually you don't want this to be, you want to see what the state average is, and you want to be above that, right? Economic drivers, like if you see this as a growing place, here's the economic forecast. So it sees growth. And there's a lot of cities, guys, that don't have future growth coming. This is great. So sectors like healthcare and IT are growing. And the labor force is growing by 2.9%, being led by these two sectors. And then when you look at the uncertainties, it's pretty much something that's across the board. It's not a local thing. You know, rate fluctuations, that's not a local thing. And so you can see the growth, you can see all this. This looks like an area that chances are, if I buy something in this area in 10 years, chances are my home value would have doubled. And you want to know how I know that? Let's see. On average, historically, how often does real estate double in growing cities or suburbs? Suburbers. I don't know how to freaking spell. So the national average, realistically, is 14 to 24%. And that it tells you the annual growth, 3%, 5%, 7%, okay? So we can look at this and see that suburbs like Zephyr Hills from 2013 to 2023, in the last 10 years, it doubles every 6 to 7 years. So you want to look at that specific area in general. I can tell you the houses that I've bought, one in Spring Hill, one in Wesley Chapel, both of those doubled in like 5 years. Insane growth. But I knew that growth was coming. I'm not saying that it works all the time. You have catastrophic things that happen, like, you know, market crashes and stuff, but you can actually do this research. And watch this. Find me similar cities to Zephyr Hills that can double in the next 6 to 7 years. And so look, it's looking up Zephyr Hills' key characteristics. And let's see if it finds me some other cities with potential. Look at this. Number 1 is Lakeland. Number 2, Cape Coral. It's crazy. And it comes up with all the reasons why, all the data. Now, obviously, you got to do your own due diligence and fact check this and go check it out for yourself. But there's a lot of potential growth here. And so if you just house hack every couple years, in 6 years, you would have 3 properties. And hopefully this one would have went from 300,000, let's say, to 600. This one would have went from 300 or from 400,000 because you bought it a couple years later to 600. And this one would have went from 500 to 600. And so you might have had 100, 200, 5, 300, 6, what is that? $600,000 in equity growth from 6 years of just buying something every 2 years. By the way, just to be conservative, I'm going to assume this is just appreciation. I'm not going to talk about taxes, right? Depreciation, the money that you make from that. I'm not going to talk about paying down your loans. And if they're cash flowing because you have renters in these two while you live in this one, I'm not going to talk about that either. Now, this is super aggressive. This is best case scenario. But worst case scenario, what if it was half? What if it was $300,000 in 6 years? That's better than you would do renting. And this $300,000 can be a down payment on a, I don't know, on a $1.5 million building if you want to play Monopoly. And the way you pull this $300K out is you can do a line of credit or you can do a cash out refi, as long as the numbers work with all your real estate. And not only can you keep all 3 of these homes, but you can also purchase a small apartment building in Zephyr Hills, let's say it's like a 12-unit apartment complex, 12 units, and you're running the same monopoly play. That's how you use equity to build wealth. That's literally monopoly. Am I familiar with the Amazon business model? How they constantly take L's on warehouse F&Bs only to squeeze to the competition. Most of Amazon's money is made on the back end. AWS, yeah, I know they don't make much money. I do think they'll eventually make money, but they have to grow so aggressively and pour so much money back into this business model. It's changing the world. To me, it's the most. Between this and AWS is changing the world as well. But to me, this is something that people have noticed change their quality of life so much, and eventually it will be profitable. I'm very familiar with the business model because I have 2 FBA accounts that each do 7 figures. And we're across their warehouses, their fulfillment by Amazon warehouses all over the country. And so we have to manage it, and it's a pain in the ass. So much so that one of the accounts we let a third party manage now because it's just too much to manage. All right. So speaking of taxes and stuff, listen, if this bill, the Trump tax bill, gets passed, that would mean we can do what's called bonus depreciation, or what is it? Or bonus depreciation, or I forget what the other term was. But if we get to do this, real estate is about to boom. If this tax bill passes, real estate, I'm not going to say it's going to boom like in the past, but we're going to see growth because investors are going to pour their cash into real estate. So I want to see why Republicans did not pass it the first round. Let's see what they had to say. This was 4 hours ago.
To stand here and tell the American people, we can cut your taxes and we can increase spending and everything's going to be just fine. But I can't do that because I'm here to deliver a dose of reality. This bill dramatically increases deficits in the near term, but promises our government will be fiscally responsible 5 years from now. Where have we heard that before? How do you bind a future Congress to these promises? This bill is a debt bomb ticking. Mr. Speaker, we're not rearranging deck chairs on the Titanic tonight. We're putting coal in the boiler and setting a course for the iceberg. If something is beautiful, you don't do it after midnight. I oppose this bill.
Gentleman's time has expired.
After a long night of very intense debate on the House floor, lawmakers have finally passed President Trump's sweeping tax and spending cuts bill. That was in the House. Now it goes to the Senate. Republicans in the House unveiled a slew of changes to the massive legislation to win over several GOP holdouts. But they didn't convince everyone. 2 GOP House members still voted against the measure, while another voted present. It's a big win for the House Speaker, Mike Johnson, who had vowed to get the bill passed before Memorial Day.
It's truly historic. The media and the Democrats have consistently dismissed any possibility that House Republicans could get this done. They did not believe that we could succeed in our mission to enact President Trump's America First agenda. But this is a big one, and once again, they have been proven wrong. Today, the House has passed generational, truly nation-shaping legislation.
And now it's up to the Senate to see what they decide. Let's go live to Capitol Hill right now. CNN's chief congressional correspondent Manu Raju is standing by. Manu, what's first of all in this House bill, and how will it affect Americans?
Yeah, this is a sweeping bill, really dealing with a wide range of issues, everything from changes on immigration laws, more money for the border security measures, as well as more money to try to increase the U.S. defense posture, but very significantly, a massive overhaul of the United States tax code. It would it would permanently extend the 2017 Trump-era tax cuts, but also add new provisions dealing with taxes on tips, changes how state and local taxes are deducted, and then spending cuts. Major spending cuts to domestic programs, including on issues like food stamps, as new work requirements for those food stamp benefits, new work requirements for Medicaid benefit recipients as well that would kick in at the end of 2026. A whole slew of changes that actually did not go far enough for a number of those hardline members who wanted much more in terms of spending cuts. They were concerned, Wolf, about the deficit impacts from this proposal. In fact, this proposal is expected to increase the deficit by nearly $4 trillion over the next several years. That is according to the nonpartisan Congressional Budget Office. And that was what a number of these hardline members had said to me going into the vote, said that they could not support something like this. But they ultimately changed their mind because under pressure from Donald Trump and from the Speaker of the House and facing this vote, they decided that they were going to accept what they ultimately could get in the bill and accept the fact that they couldn't get everything. Listen.
We have been focused on this moment for a long time, and I think that there's a moment where you just kind of take a collective pause and say, we've accomplished a lot. And so we've been heads down in this fight for so long.
What about the impact on the deficit? I mean, CBO suggests this could be trillions of dollars in the next several years. No.
That's accurate, and I don't like that one bit, but I don't know what the other option is right now.
So where does this go from here? That is the question facing Republicans, because now it passed the House by the narrowest of margins. The United States Senate will have its turn to move ahead. Republican senators have their own ideas. Some of them are concerned about those cuts on Medicaid. Some of them are concerned about how it's dealing with so-called green energy tax credits. It would phase out a lot of those green energy tax credits that were enacted under the Inflation Reduction Act. That has caused actually ample concern from some members who are worried about the impacts in their states and their districts. Look for Republicans to try to change that as well. So how does this ultimately play out? It remains to be seen, because Republicans plan to change it. Can they get the votes out of the Senate? There's still concerns on the Senate side about how all this is dealt with, and then they have to kick it back to the House for final approval. So there's some time left here, but no doubt about it, a big win for the Speaker, a big win for the President, getting the first major step done after days and weeks of painstaking negotiations.
Now it's up to the Senate to see what they decide to do. That could be intense as well. Manu Raju, thank you very, very much.
Joining us now is Democratic Congresswoman Becca Balint of Vermont. Thank you so much for being here. Look, Republicans have a very clear message this morning with the passage of this bill that now goes to the Senate. Their message is we can get things done. So what is the Democrats' message to voters as 2026 is right around the corner?
Look, this bill made steep cuts to food assistance programs, to Medicaid, and we also learned in the last 48 hours that because of the increase in the deficit, which is huge, that it also puts at risk Medicare. I have a hard time believing that senators are going to fall in line, especially when you have Senator Josh Hawley saying in recent days, we should not be touching Medicaid. For me, this is a moral line. It makes no sense in this time of incredible struggle in this country, when families are having such a hard time making ends meet, to go after food assistance and Medicaid. It will also impact rural hospitals, and I know senators care deeply about that. It's not just in Vermont, it's in every rural district across the state. I'm hearing that from my healthcare providers. This would be disastrous for them. So the Speaker can say whatever he would like, but I have a hard time believing that senators are not going to take an axe to this bill.
There was an estimated 8 million recipients who could lose Medicare coverage if this particular bill goes through. The Republicans keep saying, oh, it's only the people who can work and it's only to get them to work. It is not going to affect anyone else. How do you see it in the reading of this bill?
Well, that's just not true. We know it's not true. We've seen the scores. The nonpartisan Congressional Budget Office has laid it out for us. It's absolutely not true that it's only the people, they say, who aren't working. And let's be clear, it's not just the cuts directly to Medicaid. It is also the fact that they are not continuing the provisions that would allow people who got insurance because of Obamacare to continue that insurance. Millions.
Nobody want that damn insurance. So the bill passed the House today because they made some last minute changes. Here's the key revisions made to secure passing at the House. Okay. Accelerated Medicaid work requirements. Yes. The implementation of work requirements for medical recipients was moved up from 2029 to the end of 2026, responding to demands from fiscal conservatives seeking immediate cost-saving measures. Okay. Increased SALT deduction cap. To appease moderates from high-tax states like New York and New Jersey, the cap on the state and local tax, or SALT, deductions was raised from $10,000 to $40,000 for individuals earning under $500K, with a gradual phase out for higher earners. This is amazing. That one right there. This one, let me zoom in for y'all. Where is it? This one is going to save so much money, guys. Your property taxes are going to drop so much. Well, not drop so much, but your tax bill is going to drop so much because of this. This isn't just a rich people's thing. If you own real estate and you pay property taxes, this is going to be amazing for you. Phased out clean energy tax credits. The bill accelerated the expiration of tax credits for new renewable energy projects, requiring them to commence construction within 60 days of the bill's enactment. And yes, because we give these tax credits to people who don't build nothing for 10 years. Elimination of gun silencer tax. The $200 tax on gun silencers was removed, catering to the Second Amendment advocates within the party. Why do people want gun silencers? I mean, it doesn't matter, but I don't know that a $200 tax on a gun silencer would stop me from getting one. But I get that it's not about the money, it's about the Second Amendment. Adjusted remittance of tax. Adjusted remittance tax. The proposed tax on overseas remittances was reduced from 5% to 3.5%, addressing concerns about the financial impact on immigrant communities and international relations. Restrictions on ACA funding. So the bill prohibited federal funds from being used for Affordable Care Act plans that cover abortions, except in cases of rape, incest. Look at this. And what's going to happen is people are going to report something like, "Oh, this is it's my body, my choice." Boom, boom, boom. I love this because I don't think we should be killing babies. I am pro-life. I'm not pro-choice, but I also think that there needs to be a balance here. It shouldn't be so binary. People want to be pro-choice and allow, 22-month-old, 22-week babies. Let me see. What's the cap right now? What? Let's see what it is right now. Look at this. There are states that allow up to 24 weeks. There are states like California that allow 26 weeks. A 26-week pregnant woman, let's see what that looks like. Show me a baby at 26 weeks pregnant. Guys, these are 26-week-old babies. That is a human being, bro. Because if this baby was born, could it survive? Yes, it could. It could live. Premature babies are born all the time and can live. Oh, but they're not, they're dependent on the mother to live. What do you think a 2-month-old baby that's out of the womb depends on? You think they survive on their own? What are we talking about here? So I think this is extreme, but I also think it's extreme that if a woman's raped or she can die from being pregnant, to force her to have the baby, right? And so if you look at this bill, we can find some compromise in this world. We can find some common ground. It doesn't have to be extreme left or extreme right. And so we just don't want to use our tax dollars to cover abortions of babies just because you don't want the baby. Especially at 26 weeks, 23 weeks, 24 weeks. That's insane. But this bill is, the exceptions are cases of rape, incest, threats to a mother's life, aligning with pro-life positions. Maybe that's a religious thing. I don't know. I just don't think we should be allowing, bro, I went to a high school where there was an entire building just for mothers. Bro, 14, 15, entire building just for mothers, because these girls be just, young men and young women just be doing their thing and be having a dozen abortions by the time they're 21. It's insane. All right. With that being said, those are the new revisions that they did in this bill that got it passed. Now, it has to get past the Senate. And there's a lot of debates, as you can see, centered around fiscal impacts and social program cuts. And so the outcome is going to depend on the Senate's ability to reconcile differing viewpoints with the Republican majority and align with the House's version of the bill. You know, in the Republican Party, they're the majority party, so we'll see what happens. What do y'all think? Y'all want this bill to pass or not? For tax purposes, I definitely want that thing to pass. It's gonna free up a lot of the average people's money. I know people are saying this tax bill is for the rich. Not if you're informed. Not if you're informed. Tax on tips. Come on, that's not for the rich. What's the other one? Tax on tips, tax on... There's a few other ones that are definitely not for the rich, right? All right. I want to watch this video. She said, this video says, I retired in my 30s and now living off of passive income. Let's see what this is about. Oh, she's doing dividends. All right, let's see how she does it. Bitcoin is booming. Yes, it is. Matter of fact, I was looking at this. This is the Bitcoin price versus the global M2 money supply. You guys can see it correlates pretty well here. Now, we got a little bit of a dip right here, but that doesn't mean it's not going to keep going up, because we had a very similar trajectory right here where it had a dip, but the M2 money supply kept growing and the Bitcoin price kept growing. Now, with that being said, this came crashing down in 2022 because of, I think that's when the interest rates and credit tightening happened. That's when it came crashing down. But then little by little, we just kept pouring money into the market. We're not buying real estate, but we're buying stocks. We're spending money as consumers still. You know, I still see people in Louis Vuitton. The Bitcoin price dropped a bit, but right now it's not at 100,000. Right now, it's what's Bitcoin at right now? That's futures. My bad. BTC. Bitcoin is at, what the hell's the price at, brother? That's the market cap. $111. It's cranking right now. It's overbought though. It's above the 70. It's at the top of the band. It looks like it's overbought, but $111. Damn. It's definitely doing this. It's definitely going up. Because look, it's up here now. So it's looking like this right here. That's crazy. Crazy. Shout out to those who own Bitcoin. I own Bitcoin. All right, let's get back to this video. This girl, she's doing it with dividends. I eventually will do that too, but I gotta have like 10 million in the bank, bro. 10 million in the brokerage account to live off of dividends. What about you guys? Let's go.
Dividend paying stocks. And now I will share with you a snapshot of my dividend tracking schedule. You might be wondering, well, Jumoke, I'm not a finance person. Where do I find this information on dividends? And I'll show you precisely where you can find it.
Like, I could retire on dividends right now, depending on what kind of lifestyle I want. But if I want an abundant lifestyle, no way. No way. I mean, maybe 10 million will work, because 10 million, if I earn 5% on that, you know, that's 500K a year after taxes, $250,000 a year, 300,000 a year. No, because no, you're not going to be at capital gains. You know, those dividend payouts, if you're living on them, you're going to be taxed at income, right? So yeah, maybe 300,000 a year you'll live on with 10 million in your bank. That's not, you know, if you can be more aggressive, but I would just sell puts and live on with 10 million in the bank. Man, I'm living on 100K a month. All right, let's continue.
So how would you like to wake up every morning knowing that your bills and your lifestyle are completely funded, not by your 9 to 5 or by a job, but by passive income? Well, it's absolutely possible, because that is partly how I fund my lifestyle in early retirement. So in this video, I'm going to show you how to generate $1,000 a month in dividends, either to earn passive income if you're still in a 9 to 5, or perhaps fund an early retirement lifestyle like I did. So stick around to the end, because I'll also be sharing with you my personal dividend schedule and some favorite dividend paying stocks and funds to get you started. If you're new here, hello and welcome. My name is Jumoke. Hello to all of my new subscribers. I retired from my 9 to 5 in my 30s, and now I live off of my investments. On this channel, I talk about my journey towards early retirement, as well as personal finance, investing, wealth creation, and self-improvement. If that sounds like something that would be of interest to you, do not forget to hit the subscribe button, click the notification bell so you don't miss any of my new videos. Let's get straight into it. So what I'm about to share in this video is partly what funds my current lifestyle in early retirement. I invested in 2 types of stocks. One is growth stocks, and the other is value stocks or dividend paying stocks. And that's the portion that we're going to focus on in this video. Now, I need to give this disclaimer before I start this video. I am not a financial advisor. I am not providing financial advice or tax advice, and I will always recommend good or bespoke solutions to build and grow your wealth. Now, I built my portfolio over an extended period of time. And I did it in such a way that every single month I get dividends from my dividend paying stocks. So I'm extremely excited to be filming this video. I don't know if you can tell, but I absolutely geek out on financial markets, investing. That's just my comfort zone. And so I'm really, really happy to be sharing this knowledge with you in the hopes that it can help you start earning passive income or start saving for the future. Now, one thing to note is that dividends are subject to taxation. And what that taxation would look like will differ according to your jurisdiction. So please note, you do have to declare income on dividends and pay taxes on it. And I'll expand on the taxation side of dividends later in the video. At this point, I would like to bring us back to basics. So what is a dividend, or what are dividends?
We know what dividends are, right, guys? Y'all know what dividends are.
Dividend yield in this example is 4%. Now, to find out how much exactly you would need to invest in order to get $12,000 each year in dividends, the calculation will be $12,000 divided by 4%, which is the dividend yield, and that will give you your capital requirement, which is $300,000 a year. And this formula is exactly the same.
See what I'm saying? So for $300,000, you can live on $12,000 a year. But the people who are doing that are moving to like Portugal, Mexico City, I don't know, somewhere in South America, somewhere in Asia. Those are the people who are living on that. But I'm not doing that. Let's say it's 500,000. You know, you're living on 20K a year now. I want to be able to retire anywhere.
The same as the dividend yield formula. Just
when we talk about our lifestyle, our quality of life, what does that look like now for you? And if you're happy with that, what would it take for you to retire with the current lifestyle you have? That's more retirement, in my opinion. But to each their own. Like, some people don't need much, you know?
Just reorganized a little bit. So this means that if you invest $300,000 a year in a stock that has a dividend yield of 4%, you will get $1,000 a month or $12,000 a year in dividend payments. So let's try another example to bring this home. Let's say that you've saved up $120,000 in capital and you are after $12,000 in dividends every single year. What would be your required dividend yield? Exactly. It would be $12,000, which is your required dividend, divided by your capital, which is $120,000, which gives you 10%. So your dividend yield requirement would be 10%. And so you see, this is super interesting and quite easy once you know what to look out for.
Now, the higher dividends you get, the more risky it is. And if you're retired and you're depending on this income, 100% of this income, you know, you got to have a balance there, right? Like, you got to be careful, especially depending on what industry it is, how it's affected by certain macroeconomics or geopolitical challenges. Like, there's a lot here. The ones that are less risky are going to pay you 4%, 3%, right?
And how to connect the numbers. Now, the third step, and I dare say the more interesting step, is to choose your dividend paying stocks. As I mentioned at the start of this video, I invested in two types of stocks, growth stocks as well as dividend paying stocks. Now, growth stocks are typically stocks that are, exactly as the name says, in their growth phase, or they are stocks that tend to grow at a faster pace than other stocks like value stocks or dividend paying stocks. So you tend to find quite a few tech stocks in the growth categorization, whilst you might find banks, utility companies in the value categorization. Now, these are just 2 or 3 examples of sector classification. It doesn't mean, of course, that all tech companies are classed as growth companies and all banks or utility companies are classed as value companies. Not at all. You do have some tech companies that actually pay out in dividends. For example, Apple, and I believe Meta as well, has just recently started paying out dividends. So you do have some tech companies that are now graduating from being growth stocks to value stocks. When choosing single stock positions or when investing in individual stocks, the recommendation is to look out for stocks that have a very strong track record of paying consistent and growing dividends. And some examples of this would be stocks.
That's another thing, that if a company's looking for growth or they're scared, they have some uncertainty of what's going on in the economy, they'll stop paying dividends, right? And so she mentioned Apple, and you're probably thinking right away, oh, Apple's perfect. That's what I would buy because I know it's, that company's going to be around for 50 years. The problem is this would be your dividend yield, 0.48. So on $10 million, let's do the math on that. On $10 million, you'd live on $48,000 a year. For $10 million, man, just go buy an apartment building. Cash, and you're good. You're golden. Go get some U.S. Treasury bonds, and you're way better off. But you also have some growth opportunity, right? Except if you're retired, you're not looking for growth. And then the same thing with Meta. She mentioned Meta, but the dividend yield is 0.33%. So I'm sure she's got some amazing stock tickers though, or ETFs that pay really well and are stable. I hope she shares them.
Stocks like Johnson & Johnson, which is a rock-solid healthcare giant with decades
that's
of
a great company.
dividend increases. It currently has a dividend yield of 3.4%. Another example of this would be Procter & Gamble, which is
both stable companies. Coca-Cola is a great one. Let's see what their yield is.
Consumer goods powerhouse paying steady dividends. It currently has a dividend yield of 2.4%. And a third example would be a company like Coca-Cola, which is a dividend favorite with global brand dominance. And it currently has a dividend yield of 3.11%. A fourth example would be AT&T, which is a US telecommunications company, which currently has a dividend yield of 4.58%. Now, the first three names, Johnson & Johnson, Procter & Gamble, as well as Coca-Cola, are actually known in the dividend investing world as dividend aristocrats. And this is because these companies have consistently increased their payouts, forget this, 25 plus years. You might be wondering, well, Jumoke, I'm not a finance person. Where do I find this information on dividends? Well, thank you very much to Google because all of the information you need is online. And I'll show you precisely where you can find it. Type in the company name into Google and at the end of that, put in share price. So Coca-Cola share price. And as you can see, you get this graph of what the stock has done over time, over 6 months, 1 year, 5 years, etc. And just beneath that graph, you can also see the dividend yield. So you don't need some paid for fancy app that gives you the information about dividends. It's all online and it's accessible for free. Now, if for you, picking single stocks is overwhelming, and of course it can be when you're just starting out, this is not advice, it's a recommendation. One recommendation would be to look at ETFs, which are exchange traded funds, or perhaps mutual funds that can essentially do the work for you. So an exchange traded fund is essentially a fund that trades like a stock.
So these ETFs is what I mentioned. It's going to be way more stable because it's going to be a basket of stocks, right? You're going to get similar dividend yields to the AT&Ts of the world, the Coca-Colas of the world, but you're going to be more diversified. And you have some potential for growth outside of the dividend yields. So some of these ETFs return similar to the S&P 500, 10% a year. Right? Where 3.5% or 4% is from the dividend yield, and then 6 or 7% is annual growth, which is great. If you're conservative, you'll just live on the dividends and you'll see your portfolio keep up with inflation and continue to grow. That's kind of what a lot of investors look. That's why they use the 4% rule. You want to live on 4% of your portfolio. That will allow your portfolio to continue to grow while still while being able to pay for your lifestyle. But if 4% is the magic number, then you better have a lot of cash.
It is a basket of stocks that are focused.
Like, you can't save your way to that. You got to use leverage. You could be making $500,000 a year for the rest of your life. You're going to have expenses the rest of your life. So let's say you can save $200,000 a year, earning $500,000 a year. You'd be in the top 5% of income, top 1% of income earners in the world, being at $500,000 a year. So this isn't duplicatable for everyone. But even then, saving $200,000 of that $500K, you wouldn't have $10 million anytime soon. And even if you did, you wouldn't be living on $500K a year when you did have 10 million based on dividends.
Focus on perhaps a sector, a strategy, or a market as a whole. And there are many options to choose from when it comes to ETFs. And a mutual fund, on the other hand, is set up similarly to an ETF in the sense that it can be a basket of stocks, but it is a little bit less liquid because unlike ETFs that trade all through the day, mutual funds tend to trade once a day, which is typically at the end of the day. But the bottom line is that these two instruments or investments can be used to...
So SCHD, like Leo just mentioned, in the last 10 years, it's earned 11%. 3.39% of that was dividend yields. So great ETF, except I'm not interested on retiring on 3.39 or on 4%. I'm just not interested. So that's why I've never got into dividend yields. I'd rather invest my money into the S&P or QQQ for growth. Not just growth, but just steady growth, conservative growth, and then cash, and then grow on top of that by selling puts, covered calls, and building up my individual stock portfolio that way as well. So I think you can earn way better returns doing that and be retired and it be safe.
To achieve the same goals of cash flow in terms of dividends. Now, here are some examples of dividend-focused ETFs and funds. The first one is the Vanguard High Dividend Yield ETF. And this works exactly as the name suggests. It is an ETF that holds a diversified basket of high-yielding dividend stocks. The second example is the Schwab US Dividend Equity ETF. And this fund is focused more on high-quality dividend growers. And the third example is the Global X Super Dividend ETF. Although this ETF pays out a high dividend yield, it also comes with additional risk. And the beauty of these ETFs or funds is that they spread your...
The Schwab one, the SCHD, outperformed VYM, outperformed pretty much every dividend ETF.
...risk across a panoply of dividend-paying stocks, which makes it easier for you to earn consistent income. And also, if you have some curiosity around what these ETFs tend to hold, they actually give you the breakdown. So if you go on the page of the specific ETF that you are interested in, it breaks down its composites by sector as well as stock names. Now, you might be thinking, as I've done in the past, that it might be easier to just replicate the composites for yourself. That is a good thought. However, some of these ETFs have hundreds of underlying stocks within them. Imagine monitoring a portfolio that has 500 to 600 stocks within it. No, thank you. And that is precisely why when you invest in these funds, you pay what is called an expense ratio. The expense ratio pretty much covers the management of the fund, paying for the managers of the funds to leverage their skill sets, their expertise, their time in managing the fund on your behalf. As I mentioned previously at the start of this video, I do get paid dividends every month. And some months are a lot higher than other months. I will admit there is a little bit of an art in crafting your investment portfolio in such a way that you get monthly cash flow. And that's because some stocks pay monthly, others might pay quarterly, others might pay semi-annually, and others might pay annually. And it does take a little bit of time to do the research, figure it all out, but once you do, it is smooth sailing from there. So as a recap, in order to earn monthly dividends, depending on what levels you would like and depending on how much you have to invest, you need to, number one, figure out the dividend yields. Number two, calculate how much you need in capital in order to achieve the dividend cash flow you need. And number three, pick high quality dividend paying stocks. I am absolutely meticulous about tracking my monthly dividends. And it took me some time to structure my portfolio, as I said, in a way where I get monthly income. And now I will share with you a snapshot of my dividend tracking schedule. And as you can see, some months are a lot higher than others. You do have to pay taxation on your dividends. However, the good news is that depending on your country of residence or your investments, you get a small portion of an allowance, a tax-free allowance. I'm based in the UK and we do get a dividend tax-free allowance. It was previously £2,000. But as of the tax
not
year
much.
2024 to 5 and beyond, it is now £500. And what that means is that on the first £500 of dividends, you pay no tax. But anything above that will attract or command a
Might as well just keep it, bro. Might as well just keep it. So if my tax bill, if my effective tax rate is 16%, like we said earlier, $500, I saved $80 in taxes. Thank you so much. What the hell I'm gonna do with that? I'm just kidding. I don't want to seem ungrateful, but yeah.
A proportion of taxation, and it all depends on your income tax bracket. Here is some information on dividend tax levels, and as mentioned, it all depends on your tax threshold, and you get taxed progressively, as you can see. But there is a little bit of good news, if you can call it that, which is that dividends actually attract a lower rate of taxation than your income tax. So here are some bonus points for growing your dividend income. Number one, reinvest your dividends. You can use a dividend reinvestment plan, which essentially will help to compound your returns over time.
So America has this. We have a qualified dividends taxable income. So if you're a single filer, up to 48,000, you're probably going to be taxed at 15% or 20%, depending on your overall income level, which is great. So like if you're at the top of your income, right, and you're being taxed 37%, well, if, I don't know, 48,000 of that is from dividends, then you'd pay 15 or you'd probably pay 20% on that instead of 37%, if that makes sense. Which saves you a lot more money than what the UK is doing. Y'all be getting killed in the UK.
Time. So you not only earn on your initial portion or capital, i.e. your initial amount of shares, you also earn on your dividends if your dividends are reinvested in that share, i.e. your dividends are used to buy more shares for yourself. Number two, diversify. Do not rely on a single stock.
I covered this.
It is recommended to spread your investments or your capital.
I covered this. I think Target for value investors, I don't know what it is now, but a few days ago, I think it was a buy. It might still be a buy. But I do think there's an opportunity cost there, and it's going to take a while for it to turn around. And there's other opportunities, I think. So none of this is taught in public education. I know. Like it should be necessary to go through not a quarter or semester, a year worth of personal finance. A year.
Capital over a basket or panoply or several options of investments. Number three, focus on growth. Focus on companies that are looking to increase their dividends every year or at least are paying out.
That's not growth. Dividend growth and company growth are completely different, and they don't coexist.
Dividends consistently. Number four, seek professional help. A lot of this can be very overwhelming if you're not entirely sure of what to do or what you're doing. And so it is worthwhile speaking to a professional who is well-versed in investing and can structure or tailor a portfolio that can meet your needs. And number five, stay patient and stay consistent. The whole world of investing and wealth creation I've seen is a long game.
Yeah, so she may be retired. Congratulations. She's in her 30s and she's retired, but she's not the kind of retired that I want to be. So I could tell you right now that I could retire. I would rather buy just with two barbershops. And by the way, I own 10. But with two barbershops, I could retire on $140,000 a year passively. On $140,000 a year just with two barbershops. Do you know what it would take to do that with dividend stocks. You would need $3.5 million in your brokerage account collecting 4% in dividend yields to do what I did with 2 barbershops, and it cost me at the most $200,000 to buy these 2 barbershops. And I'd be able to retire on $140K a year. Now, let's say you don't want to retire from barbershops. Swap this out with smoothie stores, with a smoothie shop, with an accounting firm, with nail salon, with plumbing business, and build systems and hire people and build businesses. Just 2 of them. Maybe 1 would do this for you. Maybe 1. Okay, you don't want to do that. Do the stock investing course that I taught, that I have on my on here, and that'll help too. You don't want to do that. It's not the best market ever for where I live for real estate, but if you live in like Ohio or something, do real estate. In any case, if you want to retire with a better, abundant lifestyle, you got to use leverage or build businesses. Everybody on Forbes list, they didn't do it through dividend stocks. They didn't do it through real estate. They built a business first. And then they started diversifying the cash flow from their businesses or their main income, right? So even surgeons, even attorneys, even the most successful barber in the world is going to diversify and put their money to work for them in order to build real wealth. So see if there's any questions in the chat or anything in the chat. What are some good growth stocks? Go through the course, man. Go through that course, bro. I'm telling you, you can literally, let me see. Can I do a filter here? Let's go home. Yeah. So you can do, like, once you know what you're looking for, you can go through screeners, right? Let's go to a stock screener. And you want a PEG ratio of 2 and below, let's say. We can do PE ratio too, but if you want like real growth, you want to go with a PEG ratio because of tech stocks. Let's see. Performance. Do 10% and above. Return on equity. We can do 15% and above. How many are on here? 42 symbols. What else we got here? You want to look at financials. Net income. Annual. Add filter. No. Let's go with market cap. Valuation. Market cap. You want to do something that's smaller. So large, middlers. So let's go with the middlers because it's going to be hard for Nvidia to double its market cap from 3. It's literally worth $3 trillion. It's like the biggest company in the world. To go to $6 trillion in the next few years is damn near impossible. But a company can go from 2 or 10 billion to 100 billion. Right? That's possible. And there's nothing there. Let's try large caps. Okay. This is better. So we'll do large caps. And there are 39 symbols here. What else can we add? We don't care about dividend yield. Let's see what price we have here. You can go by price, but I'm not I'm not interested in that. Change, no. That's price change, no. What else do we have here? Financials. I don't need financials. I need growth. Let me see. There you go, growth. Revenue growth. And let's put 10%. Let's do 25 and above. All right, so you have a bunch of companies here. Look at Robinhood. All right. We need to, once we see these are growing like crazy. So Robinhood is definitely one of those. And honestly, this might be, how many do we have in, nope, nothing in Titans. This might be too much. Let's turn that off. There's 39. So let's see if there's anything here that we like, that we're familiar with. So Robinhood is one. Ecolab, Interactive Brokers. Look at Dollar Tree, Chewy, if you like those. Sprouts, I like Sprouts. I was looking at Sprouts for the longest. So I don't know, have y'all ever been to Sprouts Farmers Market? Y'all ever heard of it? So right now, it's not overbought or oversold. It's right in the middle. It's right in the middle. It's not close to any of the blue bands. Might be a good entry point, but we got to see the valuation, right? And so let's go back here. So what I would do is I would go SFM. I like to look at their financials on Qualtrim. This is SFM. And you can see annually, look at this. This doesn't look gorgeous. Free cash flow is gorgeous. Net income's gorgeous. Everything here screams a great company. It's buying back its stocks like crazy. You'd have to look at the CEO, see if you like the CEO. Let's look at the price. Let's look at all of it. Like, it is growing like crazy. I wish I would have bought in 2023. Look, if you would have bought in 2023, okay, let's say 2024, literally last year, if you would have bought last year, you would have went from $51 a share to 150, literally a 3x in a year. And last year, it looked beautiful too. Last year, it looked beautiful. So you got to find these stocks when, when the price is down here. It hasn't seen much growth over the course of all this time, but you don't know when it's going to pop because you might have bought it here and it looked great here in 2021, right? What I like to do is if I start seeing it around me, if I start seeing people talking about it, I know it might be in that trajectory. And then you look at the charts, you see how much volume is coming in, but this is a great company and it might grow for the next 10 years. You want to see a company that looks like that? Look at Amazon. You could have bought, look at Amazon, how gorgeous that looks. You could have bought Amazon here, and still made a bunch of money, right? So Sprouts looks like a great company, but is it overpriced? So when I'm looking at the chart, might be a good entry point, but let's see. Oh, if we look at the PE ratio, what's it at? Let's go back to my screen. 35, 31, 28. That's high. I think the S&P is 27 right now. Let's see what other competitors are. Let's go Walmart. 39, 36. Who else? Is Winn-Dixie? No, Winn-Dixie isn't public. Who's public? Whole Foods, right? Whole Foods. The hell? Oh, they're not public anymore, right? They got sold to Amazon. Let me see. Actually, what I'll do is I'll go to Grok and I'll see compare PE ratio to similar stocks in the same sector. All right, let's see what it says. Oh, I love this chart right here. This chart will tell you if something's overvalued. So if the stock price and the trailing PE ratio, okay, we really should put EPS. Let me see. Can you put stock price and EPS on the same chart, please? But as of right now, the stock price is lower than the PE ratio. Let me see. Yeah, so it's reflecting higher valuation as earnings growth lagged stock price gains. This supports overvaluation concern. It's a great company, but right now it's overvalued. If you think it's going to continue to grow, it's not. But as of right now, it is. And so value investors, they're not gonna buy that, right? If you look at competitors, you see 18.5, 25, 11.5, 8.5. You know, these might be better plays, but we would have to look at what their financials look like. So Kroger is 11.5, but I don't think that's a growing company, is it? The market cap of, let me see, of Sprouts is 85 billion. Oh no, that's 15 billion. Okay, let's see what Kroger's is. 629 million. Look at Kroger's financials. Kroger's might be the better purchase here. Their financials don't look amazing, but have plenty of growth there. The PE ratio is lower compared to competitors. Let's look at their price. Their price could skyrocket from here. I don't know. I don't like them either way because you also have to look at what sectors are growing the fastest, and you got to find deals within those sectors. And the fastest growing sectors is going to be tech, right? So that's why the NVIDIAs in the world before it blew up was interesting. Let me see if I can do this based on industry. There it is, industry. And let's do, watch this. What are the industries with the best growth potential in the stock market? Let's see what it says. In the meantime, let me look at the chat. Yeah, Sprouts is nice. Yeah, we can look at AMD in a bit. So obviously, you know, semiconductors, clean energy, cybersecurity, it's all tech. Healthcare innovation, fintech, it's all tech. Defense and aerospace. So let's, quantum computing is like, it's way, like it's got 20 years before it's a thing. Like even owners of those companies will say that. But let's go back to this and let's look at industries. So aerospace and defense is one. Biotech is another. And also, you know, industries you understand, right? Now, if you want value stocks, you're not selecting these most of the time. But this is growth. Value, you're going to do PE ratio, you know, most of the time. Electronic components. I'll skip some just in case. Just in case there's some other ones. Semiconductors, obviously. All right. We'll stick with this for now just to make it easy. But like, let's check out HWM. HWM. Let's see what that looks like. Market cap of 65 billion. Oh, and by the way, now that I've done that, I can also open it up to, let's see, 10 billion and above. Let's do 2 billion and above. Oh, look, Netflix. Netflix is a growth company for sure. So we did 300 million above. Netflix popped up. So if you love Netflix, we need to go look at that and see if it's a buy. You can see the analyst ratings right here. Mercado Libre. That's a strong buy. Might need to check that bad boy out. But anyways, let's go back. Let's look at the financials here. So this is hideous. What in the hell happened here? I've never seen a drop off like this. Is something wrong here? I mean, it's growing now. Quarterly, it looks beautiful quarterly. You guys see that? That looks pretty. That looks really nice quarterly. What's the price looking like? Oh, it's at an all-time high right now. But this could be like in the middle of a crazy growth phase, right? Like next year, this could look like, you know, $500 a share. Who knows? EBITDA is really good. It's a profitable business. Let's go to annual. Look, free cash flow is good. Net income, earnings per share. The debt is dropping. It's got 3.3 billion in debt, 564 million in cash. And then it has free cash flow of $1 billion. Not bad. It could pay this off in 3 years. It's buying back stocks. His expenses look pretty low. Spends most of his money on CapEx and a little bit of operations, R&D. I wonder what happened. So this is an aerospace company. So I would have to find out what happened in 2019. Obviously, the pandemic, it's aerospace. It never got back to 2015, 2016 numbers, though. Why? Usually what we saw from a pandemic was a steep drop here and then growth and then catching back up, if not at all-time highs, right? So we would have to know what's going on here, okay? But so far, their financials look great. And so we would have to do some more fundamental studying on this stock, but this could be something good, right? Like I would go and want to hear from the CEO. Let's see. Like, look, this is a year ago.
Let's get to Jim and stop trading.
Now, I did make a joke earlier about a stock called How I Met Your Mother, How Met. But here's 4 recommendations for it. Now, what people don't know is that this is a $21 billion company that used to be the fastening business of Alcoa. And 4 recommendations, the most recommended stock so far this year that I've found.
Really?
Yes. And
this stock was a year ago. Look at the price of it a year ago. Look at the price of it now. $163. If you would have bought it a year ago when Kramer brought it up, you could have tripled your money. Imagine turning 50 grand into 150 grand, right?
it is a very good company. It does forgings for aerospace, and GE's up a lot. I mean, people are saying, well, listen, I should go and be in How I Met Your Mother, HWM. And all I can say is that Elliott Partners was right. There was money within Alcoa if we broke it up, but it was all in this company, How Met.
Wow. I guess it's sort of a comment on the need for airline capacity.
2 million screws in the 747.
Jeez.
Yeah.
And you heard Eunice, our correspondent in Beijing yesterday, talking about the prospect of opening up more U.S. flights.
It's got to happen. Look, I think that there's, if you want to buy, remember, Macy's is the one to play. They used to send the Chinese junkets to the U.S. were 10 times what they are now. They need more aircraft. That country is in, I just don't know what's going on in that country, but that was the way that a lot of our retailers did well in New York was because of these huge Chinese travel ventures that are now 1/10 of what they were. They need planes.
So tonight, what do we look at?
Okay, I have Constellation. Let's find out whether, other than Kim Crawford, it's been good wine.
You're going to do your M&A consulting.
Yes, I am, and I do think. Look, I know Bill knows, like everybody else, that the decline.
All right, so that's crazy. Kramer loves it. I'd want to hear from the actual CEO here, but it's not a very talked about company. It doesn't seem like it. Like, I like to do this too. I'll look at other people who are analyzing a stock, right? So like this guy does an analysis.
Howmet Aerospace doubled its value over the past year, but what makes this company stand out in the competitive aerospace and transportation industries? Is it a high-flying investment ready to take your portfolio to new heights, or does it come with some turbulence ahead? Let's break down what makes Howmet Aerospace tick, from its strong financials to its growth opportunities and potential risks. Stick around, because this might just be the next big player in your investment strategy. Howmet Aerospace, trading under the ticker H.
And this video is 3 months ago. I don't like that it's an AI video. He tricked me with the old man in front of it. But like, there are analysts that talk about it 4 months ago. This was a day
Ticker
ago.
symbol HWM is up over 80% in the past year, and today we'll be looking at a solid growth stock with an incredibly wide moat, which is a great play on defense and travel. Its net income is up over 51% in the past year, and its net margin has almost doubled from June 2023 all the way up to now, so in 1 year and a half. Today we'll be looking at none other than Howmet Aerospace, an aerospace, defense, and mobility company. In their annual report, they state that they're the leading global provider of advanced engineering solutions for the aerospace and transportation industries. Basically, it produces products used in the commercial and defense aerospace sector, which represents 54% of the revenues. Then they also focus on products for commercial.
So I might listen to something like that, but I also have my own questions here that Grok helped me answer. And depending on how much you guys want to look at this, I can tell you it's overvalued by a little bit, but it looks good. So it has a PE ratio of 48, 41 forward, right? But if you scroll down here, one of the things that I like to look at is what is the earnings per share and the price of the shares, right? And it starts to also compare with other companies in the same industry. You can see other companies in the same industry, with way lower PE ratios. That doesn't mean that Howmet isn't a better business, isn't a better growth stock. The reason why its PE ratio is so high because of the potential of growth. So it does a discounted cash flow, a DCF valuation. If you know anything about value investing, DCF valuation is like the number one thing, right? And so alpha spread, it thinks it's worth $78 a stock, which is crazy. There's analyst targets of anywhere from $140 to $195. It even shares insider trading being done. It talks about the short interest, potential tariff impact. Like, this breaks it down so nice. Shout out to Grok. Grok is the best AI to do analysis on stocks. So some people want to think it's a strong buy, right? Here's the arguments for overvaluations: the PE ratio and the forward PE ratio, comparing it to its peers in the same sector, the DCF estimate of $78, insider selling and technical signals, right? There's a double top, def cross, like it's even using technical analysis. This shit's crazy. But it says there's strong fundamentals. It keeps seeing growth, return on investments, all this stuff. So I would want to learn about the company as much as possible because it could keep this up, man. Tesla did it, shocked everybody. So it says that it's moderately overpriced. And I agree with that because if you look at this chart, you can see the earnings per share and the stock price. And the earnings per share is keeping up with the stock price, and it's a little bit above it, right? So that's a good sign. But I will say this, it's not a great buy. It's not screaming a great buy. So I do like this recommendation. If you have it, hold it. But for potential investors, consider waiting for a dip. Okay, so let's look at the chart. Let's go pull up a chart here. Let me just make sure I know the stock ticker again. Stock ticker is HWM. This shit is so fun to me, especially while making money. All right. So let's look at the chart here, and it is. So look, the RSI is screaming that it's overbought. Okay, so it should be if it drops down past the 70 here on this on the RSI. Let me see if I can zoom in a bit so you guys can see it. No, that's not working. It's working a little bit. You guys can see that's the 70. If it dips back down here, that could mean it's cooling off and it'll start dipping. If you look above here, let me zoom back out. You can see it's close to the top of the Bollinger Bands, and it's well above all of the SMAs. So it could keep going up. We don't know what the volume here because it's in new territory. So, I mean, there's a chance that if it starts to drop, if it starts to drop, and we can see something here with the RSI, I'm just not buying right now. I just think it's overvalued right now. But we've done the research now, right? If we want to do even more research, we can go study the CEO, go look at their quarterly earnings, their earnings calls, right? So if I go back here and I go to transcripts and I go to HWM, and I teach all this, guys, in the stock investing course, by the way. And it's free. It's on my YouTube channel. Not this one, but the main channel. I'm not sure. Okay, so come on, load. You can see the Q1 earnings, and you'll be able to see what the future outlook is, the business highlights, financial performance, summary of CEO comments. If you like what you're hearing here, you want to go deeper, you can go to the full transcript, or you can go listen to the call, like a podcast episode, right? But this allows me to, just quickly look at what's going on here. So they're going to start buying back, which is a great sign. Man, there's just market outline and guidance. Yeah. all this information gives you an idea and conviction of where it's going. But if you do this often, you'll know what's a screaming deal. And this is not a screaming deal, in my opinion. So Grok stock is super low right now. Grok has a cryptocurrency. Are you talking about X? Because Grok is a private company. For financials, bro, and coding, Grok is crazy good. Like really, really good. All right, you guys. Well, that's it for me today. We've been live for almost 3 hours now. So listen, I'm live daily. So I will see y'all tomorrow. Hopefully keep supporting, keep spreading the word. I appreciate you guys, man. And we'll keep learning together. And it's going to be interesting as we learn together, as we keep, up to date with what's going on in the world. We become better investors. So I will see y'all tomorrow.